demais!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast where we explain the markets so you can buy more than carpets. We break down the world of investing from beginning to dividend so that you can hopefully make some returns. My name's Bryce, and as always, I'm joined by my equity buddy, Ren. How's it going, bro?
I'm good, Bryce. How are you?
Good. The intros keep flowing in from listeners, that one coming in from Darren.
Yeah.
What are your thoughts?
Well, to pull the curtain back for our listeners, that was our second attempt at it, and I thought you were gonna stumble over it again, but you got there.
Got there in the end. Thanks to Darren for that one.
Keep sending them in.
Yes, we really appreciate it. We've actually got a cracker for the next episode that we do, Ren. It's quite timely that it came in, so looking forward to releasing that one. I think it's safe to say now that I've done more than 10 episodes of different intros, and I'm ready to sort of lock down one. So if there's any preferences,
no.
Please let us know.
I'm enjoying this too much. I think you have you've set yourself a challenge now to have a new one for every episode.
Oh, goodness. It takes more brain power doing this than it does actually talking about the show, Ren. So it adds another 15 minutes of research, sifting through all of the ones that are coming in from our listeners. So, but anyway, keep it up. Really enjoying it.
Well, I think that's a cry for help to all listeners out there that Bryce is struggling to come up with them. Although, to be fair, I don't reckon you've actually come up with any yourself. I think you've only used listeners.
No,
to save Bryce's brain power, keep them coming in so he can focus on the back 20 minutes of the show, not the first two.
Yes, that's correct. So, Ren, last week we did a Basics 101 on central banks and interest rates. We've got another Basics 101 coming up in an episode's time. So we thought in between it would be a good opportunity for us just to catch up and chat about what we've actually been doing in our personal investing journey over the last couple of weeks, something that we talk a lot about off air, but thought it would be a good idea to formalize some of it on air for all of our other equity mates out there. There's been a few good developments in terms of new apps coming to market, and got a lot of questions around brokers and all that sort of stuff. So I thought maybe it's a good opportunity just for us to bounce a few ideas and whatnot off each other and see how we go.
Sounds good. Given we're catching up, and I know some listeners hate us talking footy because it is very untimely. You know, if they're listening to this 3 weeks later, it's bad content. But bad content be damned. How about those Bombers last night?
Oh, mate. I do not want to talk about that right now. I can't believe you brought that up.
Yeah, that's the only reason I wanted to do a catch-up episode.
Now you've really put me off the episode. Absolute miserable performance from the Essendon Football Club, and not looking forward to seeing them slip outside of the 8. I can't see, with so many injuries, I can't see how they're going to make the finals. I know we're a game clear in there at the moment, but there's some teams that are knocking on the door of the top 8 that are playing in much better form than Essendon at the moment. But anyway, miserable.
Miserable. Get James Hird back.
Get Joe Watson back. Anyway, all right.
All right, mate, take your mind off it. Stop thinking about footy. Yes. I've well and truly stopped thinking about the Swans, although I still put myself through every game.
They've been playing well.
We're fourth last.
That's true.
Yeah.
Yes. Anyway, enough about footy. So, catching up, Ren, should we discuss our 2 placeholder dates first?
Oh, yeah, we should. If you want to hear more of this mindless, nonsensical banter, we're not going to reveal too much about how or in what format at this stage, but you can probably guess from context based on what I'm going to say next. If you're in Melbourne, keep the 4th of September free, and if you're in Sydney, keep the 5th of September free. Just pencil it in lightly at this stage, tentative in your Outlook calendar if you're putting it in your work calendar. Because there might be an announcement coming up, and we know it's not a lot of time between now and then, so we don't want you guys to book out and miss out. So keep it free.
Keep it free. You don't have to take any annual leave. It'll be post-work. But as Ren said, pencil it in lightly. Let your mates know. and get keen because if things go according to plan, we should be able to reveal more details very shortly. So we'll leave it there, Ren, but we're both very excited.
Bryce has promised it will be the night of the year.
Yes, I will be going through my gambling tactics and we'll be smoking seeds. No,
it'll be good. Keep it free.
True.
It won't be the night of the year, but it will be a bloody good night.
Yes. Right, so let's catch up, Ren. I don't know what you want to catch up about. You don't know what I want to catch up about. So maybe we should just go one for one until we've run out of things to chat about.
So this could be a long episode then. Yep.
Oh, God, yeah. Well, let's limit it to maybe 3 main things.
Okay.
3 main things. Do you want to start?
Yeah, sure. So I guess from our last episode on central banks and low interest rates, something that I've been watching closely and I reckon a lot of people have been watching closely are 2 assets that are known, I guess, as safe haven assets. One that has traditionally always been known as a safe haven asset, and one that a few people on Twitter are trying to tell us are a safe haven asset for the 21st century, and that's gold and Bitcoin.
Yeah.
Yes.
Nice. So, yeah, that's good. So this is also one of my points to catch up about. So great that you started with that, and we can focus on mine's more so gold than Bitcoin. So I guess my question is, firstly, are you in both gold and Bitcoin?
No, never touching Bitcoin again. I do have some gold in my portfolio. I've had gold for years as a sort of, well, we'll explain why in a sec, but I actually have topped it up recently as well. So this isn't a buy and sell recommendation, but full disclosure that I have bought more gold recently or relatively recently. So I guess we should, let's explain the logic and then get into what's happened recently. When markets are down, you generally see gold going up. It's generally seen as a safe haven asset. It moves counter-cyclically. So if you think about the market, it moves in cycles. Gold, in theory, moves counter to that cycle. So when markets are down, gold's up and vice versa. But really, why you have gold in your portfolio is it's a hedge against currency risk and a hedge against inflation. So if the Aussie dollar in Australia, let's say, is losing value, it's getting cheaper, gold appreciates in value relative to Aussie dollars. And so gold is seen as a store of value that is protected from inflation or from, currencies being devalued. And what we're seeing at the moment now with every central bank around the world and a lot of governments around the world is that there's this race to devalue their currency, which is concerning and which we'll probably do more in another episode. But what we've seen is that gold is acting as it should, and it's up 25% in the last 12 months. And if all these major economies keep devaluing their currency, we'll probably see more. In theory, gold should keep going up. Gold and silver should keep going up to as people flee to safety and hedge against that devaluation risk.
Mm. And so let's chat more personally then. So I know gold is something that you've had exposure to for a while now, and more recently you said you've topped up, and I also in the last few weeks have probably put more into gold than anything else. And I'd be interested to know how you are accessing gold. I know that you think if done sort of the proper way, you would be buying physical gold and not trading it.
I've got a grill and I've got 4 rings and I've got a gold bar that sits on my desk.
Now there is good reason that you say this, and that's because there are risks with buying ETFs that just track the price movement of gold, and that's because it's not actually backed by the asset itself. So I'm interested to know how you have been buying gold, and has it changed since you first bought to now, or are you just buying into the same position?
Yeah, so you would really think that gold is gold is gold. If you're buying gold, you're buying gold, but there's a distinction that I am mindful of. Honestly, I don't know how important it really is, but it makes sense to be concerned about it for me. And so it's just a risk that I don't want to deal with. And that's the distinction is between paper gold and physical gold. And so physical gold is, as the name suggests, your the gold rings that I'm wearing or the grill that I've got on. Like, it's physical gold that you can hold. But I think it's also, if you're investing on on a market, it's what you're buying is redeemable for gold. It's one to one. One security is worth 1 unit of gold, whatever that unit is, a gram, an ounce, a ton if you're investing price. But whatever it is, it's directly redeemable. So while you may not take possession of it, you're actually investing in physical gold. Paper gold they're like ETFs and stuff like that, where for each unit of physical gold held, there may be there's more units of the security issued. So it means that each unit of the each unit isn't directly redeemable for actual gold. So I think it's just something you want to look out for. I'm sure there's a lot of ETF providers that would tell me it's not something I need to be concerned about. And look, that they're probably right. I don't know enough about it. But for me, it also makes sense to not take an unnecessary risk for something that I don't understand.
Yeah.
So for me, I've just always been mindful of investing in physical gold, or, I guess LICs they would be, listed investment companies.
Okay.
That directly hold. They wouldn't be ETFs, because ETFs just make more units unless they then go and buy more gold. So this is where I guess the limits of my knowledge. But yeah, just always look for physical gold rather than paper gold.
So Ren, the one that I've bought into, I think quite matches that description reasonably well. And I don't know if you've heard about it or if you're in it yourself, but recently I bought, its ticker is called Gold, GOLD. It's on the ASX and it's listed by a company called ETFs Physical, I think. So just to give you a bit of a rundown what it is, ETFs Physical Gold is designed to offer investors a secure way to access gold by providing a return obviously equivalent to the movement in the price. However, the good thing is that it's actually an exchange-traded commodity, and gold is backed by physical allocated gold held by HSBC Bank. And so they're the custodian of this gold. And then only metal that conforms with the London Bullion Market Association's rules can be accepted by the custodian. And then each physical bar is segregated, individually identified and allocated. And so because it's an ETC, an exchange-traded commodity, it can be created and redeemed on demand by market makers. It trades on the ASX just like an equity, is settled and held in ordinary brokerage accounts, and is priced, similarly to an exchange-traded funds. So no new securities can be issued until the bullion is delivered to the custodian vault. And it says there's not a lot of credit risk with this product. So what are your thoughts on that?
Yeah, nice one. That's actually the one that I own as well, coincidentally.
Nice.
Yeah.
Nice.
So
that's a good example.
Great minds think alike, I guess.
Yeah. So I guess before we move on from gold, unless there's anything else you want to cover about that, I'm interested, have you a percentage allocation in mind as a total percent of portfolio that you want to have exposure to gold, or are you just buying per paycheck, or what's your thoughts on how you will allocate?
Normally it's about 5%. Recently it's sort of maybe doubled. Now it's about sort of close to 10%. I don't think the world is falling down. If you've been on financial Twitter in the last 2 weeks, you would actually think that the whole global financial system is about to collapse. I'm just, a little bit concerned by what's going on in US and China, and if everyone keeps cutting rates to try and devalue their currency more and more, we're going to see a race to the bottom. And if we do see a race to the bottom, then you want to hedge against that currency risk. So for that reason, I'm just going to keep every now and then upping my exposure to gold, while at the same time hoping this all passes and I don't actually need to be so exposed.
Yeah, nice. So I'm sitting at about 6.25% as exposure at the moment.
At about 6.25?
Well, it's 6.26 if I'm to be specific.
Good. Yeah. I think, look, for me, it always makes sense to have some in your portfolio. The idea of counter-cyclical assets generally is if you have a terrible time in the stock market, these assets should go up if everything else goes down. And what that means for a long-term investor is there's an opportunity to sell that once it's gone up into the teeth of a really bad market and buy some really cheap things. So, if gold, I actually don't know how gold performed in 2008, but if gold spiked when the share market collapsed, in theory, you could then sell that gold after it spiked, and then use that money to then buy shares really cheap, and then you would have been able to, get the last 10 years of the bull market. So that's the theory of how it should work. Obviously, you have to be pretty brave to invest in the worst times, but consistently, people that do that do very well for themselves.
That's where the money's made.
Yeah.
Just back on percentage allocation, a lot of questions coming around capital allocation. When you're talking about 10%, are you looking at 10% of your invested funds, or do you include your cash balances as well?
I include my cash.
Yeah, nice. Okay.
Because, look,
so do I.
You're making to hold money in cash, you're making a investment decision. You're allocating that money there deliberately.
Yeah.
Hopefully people are putting thought into it. And for me, having cash as a rainy day fund is worth it. It also gives you options if something goes wrong and you want to invest. But yeah, you gotta include it.
Nice. Okay.
I don't really know. I can't really explain it. And I'm sure people a lot smarter than us are looking at it. But just Google Russia and China buying gold. The amount of gold that those two countries have been buying recently and have been ramping it up in 2019, I don't really know what it means, but it's happening and it probably is significant.
Interesting. All right, I'll have a Google after this episode. So, something I want to catch up about, Ren. I'm not sure if you've seen the latest introduction to the finance world in terms of apps, but CommBank have recently released a new app to market called Pocket, and it's blowing up online. A lot of listeners have been talking about it in our discussion group on Facebook. So I thought we'd just have a quick chat about it interested to hear your thoughts, and also hopefully this is obviously not sponsored by CommSec in any way. If they're listening, hit us up. But I think it's got some positives that all other equity mates could benefit from. So have you heard about Pocket?
I was just going to say, before we get into it, when we last talked about a big bank product, we got some not hate mail, but we got some aggressive correspondence about the NAB equity builder and how we missed the point. I still don't think anyone, I don't know if we did, but anyway, hopefully we can get some more aggressive correspondence about this Pocket app.
Yeah, look, by no means is this a promotion for CommSec Pocket, but it's just another addition to all of the apps that are out there. So Ren, CommSec have released an app that helps everyday or anyone invest directly into the share market via exchange-traded funds for as little as $50, I think it is. Now, the big difference there is that, I guess...
For as little as $50, as in your minimum investment is $50?
Yes, minimum investment is $50.
Not $50 brokerage.
No, $50 minimum investment is $50. Compared with your standard 500 on most of the bigger brokerage platforms these days. So what they are trying to do is offer a very cheap and accessible way of accessing exchange-traded funds. And just like the trend is at the moment, they're also offering an automated regular investing option as well into ETFs. So the good thing, Ren, is that it's $2 brokerage for trades up to $1,000. So it's pretty cheap, and it's zero ongoing account keeping fees. At this stage, though, there are a limited number of ETFs available. To name a couple, we've got the Aussie Top 200, which is the largest 200 companies in Australia. They've got a Global 100, which is the 100 global blue chips. They've got an emerging markets, an Aussie dividends ETF, so large Aussie companies that consistently pay above average dividends. So if you're looking for some income, they've got a tech ETF, sustainable leaders. I'm guessing that's through BetaShares, and also a healthcare one. So a reasonable amount of options there, but I thought it was interesting that They're now separating their platform from traditionally having CommSec, where you go and do all of your investing as both you and I do. Now they're obviously seeing that there's this trend in ETFs and also the desire for it to be done as cheaply as possible. So I'm interested to see. I think this is going to have pretty good take up from a lot of people. What are your thoughts?
So my first thought is the $2 brokerage red herring? Is it actually the best option? And while you were just explaining the different ETFs there, I just seized on your ASX 200. So I had a look online, and Pocket, the ASX 200 ETF that it has, is the iShares ASX 200 ETF by BlackRock. The management fee for that is 9 basis points, 0.09%. And from memory, BetaShares has the lowest management fee on an ASX 200.
Yeah, they've got the ASX 200.
0.07% management fee. So look, not wildly out of line, but it is less for BetaShares than it is with iShares. So I guess the important thing to keep in mind is over time, the $2 brokerage may be cheaper than $6 with CMC, $8 with IG, whatever some of the other cheaper ones are. But if you're paying an extra 2 basis points every year as a management fee, over a long period of time, eventually you'll come out worse off. It depends how much money you've got in and all of that in terms of how much, but something to keep in mind that brokerage is only part of the fee structure when you're talking about ETFs.
Yeah, no, it's a very good point to consider.
In saying that, making it easier for people to get into the market and to get into some of these ETFs, which is still, like iShares is still very cheap, like 0.09 is extremely low. So in saying that, I don't want to, rain on the app. Just important to keep the full fee structure in mind.
So when I did a bit of research for this, CommSec had released a few points from a survey that they'd done, and they concluded that currently just 4% of Australian adults place a trade online in the share market each year. I'm assuming that's outside of superannuation. That would be direct trade.
Jeez,
so 4% of Australian adults, with the number one, that's tiny, with the number one reason being that they feel the barriers to getting started are too high. So I guess that's what we're all about here at Equity Mates anyway, Ren. So opportunities there, but I was astounded at only 4% of Australians. So certainly opportunity.
Opportunity for CommSec Pocket, but also opportunity for Equity Mates.
Big time. Big time. We should be aligning with CommSec. Anyway, let's move on. So anything else from your end?
Yeah, well, we touched on it earlier, but Bitcoin's back.
Yeah, Bitcoin's back.
So to give people...
But you're not.
No. Well, my Bitcoin journey was, as it ran up the first time, telling you guys that you were dumb to be in it and that I wasn't going to get swept up in the fad, only to break down and invest right near the top and just ride it down.
No, not right near the top. At the top. Come on.
Yeah.
Come on.
Oh, it was dumb. It was so dumb. I got off my high horse and threw my money away. I could have stayed on my high horse and would have been able to crow about it to this day.
For this whole time.
So as an interested observer but not active participant in the cryptocurrency market, so in AUD, to give people an idea of the ride that Bitcoin has been on, it got up to 25 grand for one Bitcoin, $25,000 Australian for one Bitcoin in December 2017. Then it collapsed in 2018, and at its low, it was just $4,000 for one Bitcoin in December 2018. Since then, so in 9 months since then, it's up 400% to a bit over $16,000 for one Bitcoin. So not quite at its highs, but definitely trending in the right direction for those cryptocurrency inclined investors. Which, is that you or is that not you?
I am in Bitcoin, and it's surprisingly higher than I thought. It's because of the rise in price. It's actually 3.16% of portfolio at the moment. So almost as much of an exposure to Bitcoin as I have gold, but that's just because of the run that it's had over the last few weeks or months, as you talk about. So maybe I'll consider doing something about that because it's a bit higher than I thought it would be, to be honest. But yeah, I don't really have a plan with it. I'm just going to sit it in there. It's something that for a while I've thought if it goes down, it goes down. But I would like some exposure to it. If it's going to go the way that some of these FinTwit people think it is, then I want to be part of it.
I know we've been shitting on FinTwit, is that financial Twitter, whatever it's called, a lot. But oh my god, like you would actually think the sky was falling in.
To give our new listeners to the show a bit of an insight into FinTwit, firstly, welcome to the show. Thanks for joining the journey as we learn to invest. But FinTwit is, I guess, a community on Twitter that is solely discuss how the finance and economics and all things related currently at this point in time and across the globe. And as Ren's alluded to, there are a lot of people with some very strong opinions, and whilst it's entertaining to follow them, yeah, you can certainly go in and have an image painted that is pretty negative at the moment, especially over in Europe. It feels like everything's about to fall off a cliff. So, anyway, worth following. If you have Twitter, jump on and try and follow some of the people, if anything, just to get an idea of what we're talking about.
Yeah. So Bitcoin, I don't really know what to say about it, to be honest. It is what it is. It'll probably keep running until I fold and put more money into it, and then it will collapse again. So as a commitment to all of our equity mates out there, I'll announce on the podcast before I'm going to buy it and give you guys at least 24 hours to sell before I buy in.
You're the barometer for the success of Bitcoin. Yeah. So, Ren, I've just got one more thing to catch up on before we wrap up, unless you have anything else as well. Mine's very brief, just an FYI for you and anyone else. I have decided to test out SelfWealth, the broker. There's a few people chatting about it. I wanted to see what it's all about, so I've signed up to place some trades. I know they're $9.50 flat fee for every purchase, so a bit more expensive than IG, but they're not a custodian model. You do take full ownership of the stocks. But one thing I want to just share with you, and I'm interested to hear your thoughts because I'm not sure how I feel about it, but they just sent an email at the end of the week to me, so week 31, your portfolio performance for the 3rd of August to the 9th of August. And in big letters, it says, how much have I made this week? And tells me how much I've made as a percentage. And then it tells me my net worth. Then it tells me my 12-week performance snapshot.
What's your net worth?
But then it gives me...
no, you don't have to say.
But then what I found really interesting is that they put you in brackets of where you're performing compared to everyone else in SelfWealth.
Oh, that's interesting.
And so they're like, are you in the top 4%? Are you in the bottom 4%? But the way they say it is that the scale is literally from good to bad, and you get put on that scale. And I don't like the idea of being... Well, I just don't like the idea of being put in a bad end of a scale when you're investing.
Yeah, I was going to say the interesting thing is there's some very clever psychological decisions that they've made from a business standpoint, but not great for the investors that are on their platform.
Yeah, I'm very unsure about how to feel about this. And then they give the top 3 investors who have performed well this week and what their portfolios are up. And then they also give the top performing stocks and the least performing stocks. So the whole thing is about community, and you can follow other investors and see how their portfolio is tracking. And if you want to mirror their portfolio, it'll tell you the stocks that they're invested in and that sort of stuff. So from an exploratory point of view, to find new stocks and see what others are doing, it's great. But I'm not sure about getting told week on week how my stocks are performing and where I'm placed relative to everyone else. I think it drives quite short-term investing behavior, which we're not quite really about.
Yeah. So I'm going to say something really controversial, and hopefully someone at SelfWealth hears it and they come on to defend themselves.
Yes, yeah.
Brokerages make money through transaction volume. They don't care if you're making money or not. They just clip that $9.50 every time you make a trade.
Yeah.
All of those things in the email seem to just lend themselves to, and like cleverly from a business standpoint, but to manipulate people, well, to encourage people to just trade volume, to try and be told, like there's something psychologically damaging about being told week on week that you're bad.
Yeah, that's
and
what
that
I mean.
you're the worst on the platform.
Yeah.
And vice versa, there's something psychologically nourishing about being told every week that you're good and that you're better than your peers at something that's so critical to, you know, your life, as in making money and being able to, you know, to trade well. I think that's a damaging email to send weekly, especially to people who are just starting to invest.
Yeah, I completely
I think
agree.
it incentivizes the wrong behavior, and it incentivizes behavior that's good for self-wealth as a business.
No, fully agree. I think when I got it, I was a bit, this could go either way. And luckily, so far, the last week performed well, but it could be quite off-putting, especially if you've just started, as you said, and find that you're consistently in the bad end of things. It's not. We all know it's a long journey, so being told week on week where you're at could have some negative effects. But yeah, just thought I'll keep you updated to let you know how I track with self-wealth.
Well, let's get, if someone from self-wealth is listening, come on, let's have a chat about it.
Yeah, sure. All right, we'll try and follow them up. All right, Ren, one more thing from you. What do you got?
Okay, so now I got to choose of my final two. All right, yeah, so the Australian one, a lot of people, well, some people may have seen that Rural Funds Group,
Yes, good one.
ASX RFF, had an interesting week. So I just wanted to have a chat about it. So the week or the week and a half that was, the company was down 43% in a day on the back of a short seller claiming that the company inflated their rental income and inflated the value of their property. And then in the couple of days since, it was back up to almost parity. I think it was up. It's back up about 33% after it fell.
Didn't it go into a trading halt?
It did. It did go into a trading halt, and then it exited the trading halt after the company's management strongly refuted all the claims. They stood behind PwC's audit of their books. They did admit one error, which I found kind of strange. So they, in their books, or in the annual report or whatever it was, they said they had a $8,000. They loaned out $8,000 to an associated company. They did admit that it was an error, and the loan was actually $14.4 million, which seems like a big error. But they said it was. I think they said it was like a formula error in a spreadsheet or something. But to the crux of what the short sellers were claiming, they strongly refuted it, and the market obviously listened. They're currently getting audited by EY, and I think we'll see that in a couple of weeks. So it'll be really interesting to see. But the thing that I found interesting is that this short seller, Bonitas Research, is an American firm, but they're also the firm that sank Blue Sky Alternative Investments, like 6 months ago or something. So if you don't remember that, Blue Sky invested in like just alternative assets. I think like water futures and other things that are hard to price, unlisted, quite exotic. And they were, the market liked them, gave them exposure to different assets. But anyway, this short seller wrote a scathing report about Blue Sky, and Blue Sky tanked. It looked like they just followed the same business model here, the short sellers, but it looks like this time the company's fighting back and maybe having a little bit more success. So it's interesting. It's an interesting business model, this short selling and then going really public with your concerns business model.
Yeah. One of our listeners wrote in, I'm not sure if you saw it, but it was a pretty good idea for an episode, and that's looking at examples of this, over the last few years, not necessarily always driven by short sellers, but more around when there's a dramatic one-day drop in share price, the case study around how it recovers and how soon it recovers after, and almost piecing together overall returns if you pursued a strategy of taking advantage of huge one-day drops like this and trying to buy in and I guess sell out when it rebounds. It seems like this one rebounded quite strongly, whereas other ones, say AMP, that had a huge one-day loss, it hasn't recovered and I guess also continues to slide. So it'd be an interesting exercise to do.
It would be. On AMP, they had their annual report recently. Shocking, just by the way. But on the short sellers, it is interesting. Our sometimes friends, sometimes rivals over at the Motley Fool on their podcast were talking about how they thought short selling shouldn't be legal in the markets, like it should be banned. I actually don't agree with that at all. I think the amount of frauds the short sellers catch, that auditing firms and accounting firms don't catch, that market regulators don't catch, and that government regulators don't catch, I actually think short sellers play a really important role in the financial system. And you only need to look at, one of our mates is obsessed with Mark Cohodes, the American short seller, but you only need to look at his history of finding frauds to realise that he's definitely added value and definitely saved a lot of investors a lot of money. But yeah, I mean, there's always the controversy, like if the short seller's wrong, which who knows at this point in this case, but it's an interesting one to keep an eye on if you haven't been following it so far. It seems like it's a battle of a big US short seller against an Australian agricultural company, and both sides aren't backing down at this point.
Yeah, I think they're a very important part to the total ecosystem in investing. I think, if they're wrong, so be it. It's not too dissimilar to some equity analysts coming out and saying that, target share price is $10 to $20 above current, and them being totally wrong as well. So just obviously the short sellers have a much more negative light, shining up much more negative light on the company, which is why I think they're obviously hated more than other people in the industry. But yeah, good find, Ren.
So if people want to hear us talk more, we will still stick to a sort of time limit. Pencil in September 4 and September 5 in Melbourne and Sydney respectively. If you're not in those two cities,
yes,
we get your feedback that we haven't been to your cities yet. If there's enough support from any one city, hopefully we'll be able to get there in the near future.
Absolutely. So Canberra or Brisbane, whatever.
Perth,
let us know
Adelaide,
if you can. But yes,
Darwin,
Perth, Adelaide, Wagga,
New York, LA,
Junee,
really,
London,
wherever.
Anyway, Ren, good to catch up on some of the things that we've been looking at over the past couple of weeks. Hopefully everyone got something out of it, and always good to chat stocks, and we will touch base again next week.
Sounds good.
Equity Mates and the people appearing in this program may have positions in the companies mentioned. This is general advice only. Please speak to a financial professional to understand how it may pertain to your individual situation.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity